and welcome to The Trade. Before we get into the technicals, a quick look at what traders are watching. And the US and Israel have continued to bomb targets in a day described by both the Pentagon and Iranians as the most intense airstrikes of the war so far. Iran's Revolutionary Guards said they would block oil shipments from the Gulf unless US and Israeli attacks cease. Now, both CBS News and CNN have reported that Iran has begun laying mains in the Strait of Hormuz, while President Trump has added that 10 mine-laying boats had been destroyed by US forces, and he threatened Iran if they planted explosives in the channel, posting on social media that if Iran has put out any mines in the Hormuz Strait, and we have no reports of them doing so, we want them removed immediately. Beware as well in capitals. Well, US Treasury yields mixed, with the 2-year yield rising to 3.59%, the 10-year at 4.15%, and Australian 3-year government bond yields close to 4.5%, the 10-year up to 4.9%. Markets pricing in a 65% chance the RBA cash rate will be hiked by 25 basis points at next week's meeting. And this, as Deputy Governor Hauser said, further inflationary pressures from Iran would be unhelpful, saying we've had some data that seem to have confirmed even more decisively than before that our economy currently has limited spare capacity. Just a quick look at currencies as well, which we will get into in detail in a moment, but the Aussie dollar still holding firm at 71.3 US cents. Let's get across the technicals now. Chris Weston from Pepperstone joining me. And Chris, you know, such huge moves coming through in crude, and volatility particularly is just so spiking, I guess.
Yeah, I mean, that's been the preferred channel for people to hedge out any kind of tail risk that could come through from the situation. I mean, we've got a chart in a minute, but let's focus on the chart of Brent at the moment, because I think, you know, you saw that big move up on Monday. We got up to $120 a barrel. Obviously people sort of saw the weekend. There was no sign of, you know, any kind of togetherness, I suppose. And you saw that massive, this 4-hour chart though, so you've just seen the sort of more pronounced moves up there. So obviously liquidity being an issue at that part, and that, you know, a lot of hedging activity. People were trying to price risk. That's what we do as traders, that's what we do as investors. We try and price the perceived risks in both directions, and we try and price certainty. And when that certainty is really hard to see and we get low visibility, of course, the dispersions in views become ever greater, and that reduces the liquidity on top of book, and that can force prices much more aggressively. But then obviously we've seen, at that time we saw extreme volatility coming through. We saw dislocation starting to emerge, inflation expectations rising in the US quite sharply, commodity prices outside of energy. We saw, fertilizer prices spiking as well, and the Middle East accounts for about 45% of fertilizer, and that meant that food prices such as soybeans, soy mills all started moving up, and we saw equities coming down. So of course that's when we've seen the reaction. Trump, talking about trying to appease the Straits of Hormuz. We saw the G7 nations, and we've seen breaking news coming through now about releasing strategic barrels into the market. But clearly the levels of volatility there was so extreme. But now we're actually seeing downside. So the question is do you want to be shorting the market now? Because let's say fair value, if pre the Iran conflict was $60 for Brent pricing, do we start mean reverting? Well, if you have a look at the chart that I've got of the volatility channels, which, as I say, is what everyone's been looking at, this is a really key input for all traders, really. I mean, I'm not sure if you've got the
we do.
The
we're just a little slow today, Chris. We'll get the volatility chart up for you in a minute.
That's all right, because look, volatility for me in markets is absolutely essential of everything what we're doing. And what we saw, and what we're still seeing now, and if you look at the top pane, it's a little bit sort of on the complex side, but if you have a look at the, what I've got is the difference between, actually let's start with the bottom one. So the bottom pane shows the implied volatility, which is a key input driven by market makers for the pricing of options. And what we've got there is a 5 delta call volatility. So that's wherever the strike is, it's basically saying there's a 5% probability that this the crude will go in the money at that strike. Very, very far out the money. But people use that as a way of expressing tail risk in the market. And you can see that the implied volatility in those deep out of the money calls really far above the market, say like 170 on Brent prices. Yeah, you can see that's absolutely ballooned. So there was massive demand, effectively, for these call optionalities that give you the right to own the oil when it at the strikes there. But you can make money without taking delivery. So huge demand in upside calls. And what the top pane shows is that implied volatility of calls relative to the implied volatility for puts, which obviously give you downside in the crude price. So what you see there is the highest, what we call the skew of call volatility relative to puts. Yeah, I think we've seen for a long time. And what that does is it shows you just that huge demand to hedge out that upside risk that could permutate from something going awry in the Straits of Hormuz. We obviously know that that's basically ceased to a standstill. We know that a lot of the Gulf nations have curtailed production to an aggregate of about 6 million barrels a day. That got priced in, but people are betting that that things could get more sinister, and you've seen that in the options channel. Where this becomes really important for traders is when you see these levels of extreme volatility. You can have a look at the OVX, which is the oil ETF, effectively the VIX for oil markets. Trading well above 100% and extreme levels. You've got to ask yourself, do I want to be in the market? Do I have edge in that situation? Because what you've essentially got is a market that's pricing massive moves on a daily basis, 10% up or down on a daily basis, driven by headlines that could come out at any stage. And we know that the algos are going to compete and beat you 10 times faster, hundreds of times faster than you can. Have I got any edge in that market with liquidity so thin? A headline could drive the price 5% in a swift heartbeat. For me, that's when you see that sort of levels of implied volatility, I have no edge. I want out of that market, and that will dictate the market conditions that I trade in. A lot of people do find it very attractive because you could obviously make 5% in a heartbeat if you get it right and you feel like a hero. But what we've seen is extreme volatility price and implied, and that still remains the case. So the market has pulled down some of that volatility, but it's still at the case where people are still expecting big moves. And you've got to ask yourself, do I have edge in that sort of situation in a headline-driven market where headlines, as I say, can drive the price 5% very quickly? And that's the key input that we're seeing from that chart.
All right, well, let's get into what we're seeing with currencies as well, Chris, particularly with the Aussie. You say this is the place to be this year. I mean, we were just talking about how there's a 65% chance we could see a hike next week. But don't look at Aussie US, look at Aussie Japanese yen.
Well, you look at Aussie US. I mean, we can have a look at the chart of Aussie yen in a second. But I mean, the Aussie is performing well against all cross rates and all currencies. Aussie against the US dollar, I think, for a continuation of the bull trend we've seen since November, you need a daily close above 71.50, and I think that gets it done for me. But the Aussie is the superstar currency this year. It's the best performing currency by a small margin now against all G10 currencies. Now you've got to ask yourself why, and what we've got is the chart against the yen. Why do we like it against the yen? Well, the yen hasn't really worked as a safe haven in this higher volatility environment we've been seeing. And of course, a lot of that volatility has really been confined to the energy markets. That's where we got the extreme vols. Now, the VIX has pushed into sort of 25%. But, the drawdown in the S&P has been, contained down to the 200-day moving average. Chinese equity markets are trading in a sideways consolidation pattern at the moment. But, so the Aussie dollar is a pro-cyclical risk currency, but generally speaking, equities have held in pretty well in this environment. But we like it. We like the Australian dollar against the yen because we have seen a terms of trade shock, but it's benefited Australia, whereas Japan is a massive energy importer. So we've seen a relative positive terms of trade shock here. Relative rates are obviously favouring Australian dollars at the moment. It was very much seen that May was going to be the time when the RBA were going to hike, but the market's saying we don't now need to wait for the February CPI monthly numbers that come out on the 25th of March. We don't need to wait for the Q1 CPI numbers that come out on the 29th of April. Like we heard from our Deputy Governor Hoyser yesterday in the unscheduled podcast, like we've heard recently from other RBA communique, which is basically saying that it's a live meeting. So the question is why would they wait if they know that inflation is a problem? We know the price pressures are feeding through to the consumer. Why wait is the situation. So you say 60%. I think it's moved down a touch now to sort of 57%. So it's still very much a line ball call. But the question is, if they're going to go in May, well, why? And they're debating it here. Why were they should just go sooner? But what's more important for the Aussie dollar is that by December now, the market's pricing in, two 25 basis point hikes and a 30% chance that we get a third. So there's no other, apart from the RBNZ, I think we've certainly got the most aggressive priced rate hiking cycle, positive terms of trade shock. And let's face it, regardless of what you think of Labour, on an international basis, they are seen as a predictable, safe pair of hands relative to other governments. We've got a low fiscal risk compared to the UK, Europe, and the US, and they're all very attractive places to be with stable growth. And that's why, for me, the Australian dollar is the superstar currency this year.
All right, looking forward to lots of international trips then, Chris. Thanks so much, Chris Weston.
Get to Japan.
I've been. It's too crowded now. All right, have a good day, Chris. Chris Weston from Pepperstone. We're going to take a short break. That does it for this edition of The Trade.